Friday, July 6, 2019, Maneco 64, home of alternative economics and contrarian views. Before I start today, I'd like to thank all my viewers, all the subscribers for their support, for commenting, for sending me messages, for interacting. I try to answer as many questions as possible in the comment section. Also, I recommend you follow me on Twitter. I do tweet once in a while, and you can follow me there, and I'll follow you, and you can message me there, and we can chat as well through Twitter. It's at maneco64. I'd like to thank all those of you who have donated to the channel through Patreon or PayPal, and also bought some merchandise in the Maneco 64 Teespring store, which the link to is below in the description. Right now, I've got a new Maneco 64 t-shirt and a new Keep Stacking t-shirt, which the slogan is keep stacking and take control of your money supply. And with that comes, the theme of the video this morning is that in times of monetary upheaval, which I think we're most definitely going to in the near future, hard assets are very important to own. People with hard assets usually protect themselves quite well when that happens. And there's an old saying, and I think we are in a period of the return of your wealth or money is more important than the return on your capital or on your money. So I'm gonna go back to post-World War II, just after World War II Germany, in this book, War and Gold by Kwasi Kwarteng. I'm halfway through it. It's not as fun to read as The Mandibles, so to speak. It's more of a historic book, so it's taking me a little longer, but it's a very interesting book as well. And yeah, we all, when we think of Germany and hyperinflation, we think of 1923, and I've done that in the past as well, even in recent videos. But there was a huge collapse of the currency as well right after World War II, and I'm gonna look into now how the Deutschmark was created. And it's a great example of what I've just said, that in times of monetary upheaval, the people who have held on to hard assets, they benefit the most. The people who don't, they lose the most. So I'm gonna go to page 183 here. And this is about the monetary reforms that the Allies were trying to, how can I say, bring about in Germany. There was a problem because the Soviet Union was an ally. They occupied the eastern part of Germany. Then you had the US, UK, and France. And they had trouble, of course, getting a pan-German monetary reform. So this, the eastern part of Germany was left out. The Soviets said that that would divide Germany. I guess they were right. But let's see what it says here. It says, persistent bad relations between the Allies and the Soviets during the first half of 1948 led to the eventual introduction of the Deutschmark. So yeah, the Deutschmark has only been around since 1948. Prior to that, of course, it was the Reichsmark in the French, British, and American zones on Sunday, June 20th, 1948. Citizens in these zones were permitted to convert their first 60 old marks into 40 Deutschmarks. Beyond this amount, old marks would be converted into Deutschmarks at a rate of 100 to 6.5. Pension salaries and rents, conveniently enough, would be converted at a rate of 1 to 1. And here's the part that is interesting. As so often was the case in periods of monetary upheaval, people who own hard assets like factories and property benefited, while many others saw most of their savings disappear as a consequence of the reform. So there you go. It's doesn't get any clearer than that. So what kind of monetary mayhem could we have? Well, we're seeing now central banks moving to deeper and deeper negative rates. They're going to continue to print money. They're going to continue to cut rates. And I think the Federal Reserve is going to be next, to move towards zero rates, which they have been close to before. But I think you could see Treasury yields drop quite a lot. Yeah, we're told that the inflation is very low, below 2%. But we know that the cost of living is rising more than that. Those of you who have seen shadow stats know that the cost of living, or CPI, is probably rising more like 5-6%. So, yeah, investors feel that they need to search for higher yields. But all that higher yields mean is riskier assets. And that's why we're getting a lot of problems these days with illiquid, assets, because a lot of pension fund managers, a lot of fund managers, they're looking for these illiquid assets that don't trade too much, that usually yield more, like 5, 6, 7%. But then you get the case of Woodford, where the clients want to liquidate their assets, their funds from the fund, and they have to ring fence the fund or freeze the assets, and then you lose your capital. So that's what I mean in a time of monetary mayhem, and I think we are in a time of monetary mayhem. It might not feel for younger people or even older people who haven't looked into monetary history, who are more concerned about their everyday life. We are not in a normal period. Interest rates prior to 2008, they used to average 5 to 6, maybe 7% in the last 200, 250 years, the 10-year government rates. Not the 2, 1, or even minus 40 basis points that the German 10-year Bund yield is not returning right now. So you are paying the German government now minus 40 basis points to lend them for 10 years. And yes, people have asked me, why would people do that? Well, as I've said before, the price of bonds are inversely related to the yield of bonds. So I've taken a little chart here of the German Bund future, the 10-year Bund future, which was a contract that I used to trade the most in my career as a futures and options broker. That's like the bellwether benchmark government bond future for Europe. I used to trade 10 years or treasury futures as well, but the Bunds, they're a huge contract, and they probably still are. I remember back in the 90s, the price of the Bund future was below 100. I remember very well, I think it was 1994 when we had data from Germany. The money supply M3 came out like a growth of 30%. It was a huge surprise. And the Bunds dropped to like 92. I remember that really clearly, mainly because I bought a put in the Bunds just a week before because I felt the market was going down. But here we are now. This is what I mean, that speculators and even investors, they will buy the Bunds, even though it means lending to the, paying the German government to lend them money. Because look at the price. Since, 2010, we've gone, well, let's look at actually 2009. We've gone from around 110. Look where we're now, 173. So that's how, the deeper into negative that yield goes, the higher that price is going to go. So this is a massive bubble. Even if you do get your money back from the German government, it could be a lot less, unless, it will be a lot less, because you're going to have 40 basis points taken away from you every year for 10 years. And you could have a massive reversal of this. You could see interest rates go up for some reason and actually this price turn around. So it's a dangerous game. So as I said, how do you guarantee return of your asset? Well, as this book says, in times of monetary mayhem or reforms, which I think we will get, having hard assets like property, unencumbered, of course, factory, land, precious metals, gold and silver, or any other thing, even collectibles. I mean, you might be into collectibles. Of course, they're not as liquid, but they will maintain their value over time. Diamonds, they're not as liquid as well as gold. They're not divisible. They're not really money. But yes, I think that's the other bubble we have is a bubble in the industry of hedge funds, of investment managers. I went, earlier this week on Monday to an alternative investment conference in the city of London. Yes, there's a lot of people employed by this industry. And, listening to those people, their main objective is getting their clients a return. But, and there's nothing wrong with that, but I think they need to realize that we are in a period that's not normal, and they might actually put their clients' funds at risk by trying to get a return. As I said, trying to get your money returned will be the key, I think, in this era of, NERP or negative interest rates, financial repression. It's an era, an era that we're living where the debtors are being, protected. So, yes, holders of savings or capital are being punished, and they're being punished and pushed to spend or go through their capital. Put it in risk your assets. I think it's more important than ever. It might not sound, great that your money is not getting an income or a return, but I think it's better to be safe than sorry. Of course, this is not financial advice, and it's just my opinion, and you need to do your own homework, your own, you have your own circumstances. You might need some income. I think it's always prudent to have some protection in hard assets, be it precious metals or be it property, be it land, collectibles, antiques, fine wine, whatever. Because that, as you saw here, if you have a lot of financial assets and savings in paper, when the potential reset or reform comes along, the people who have those paper assets will be, have the short end of the stick. So what about the markets? We're back on, markets are back open again in the U.S. today. Later on, we're going to have non-farm payrolls, the U.S. job data. I saw a headline saying that a very good number for the economy would be bad for the markets because it would probably stop the Fed from cutting, right? What's the expectation for non-farm payroll? Well, it's an increase of 160,000 versus 75,000 last. Unemployment rate is expected to be at 3.6% versus 3.6%. The other thing people look at is the average hourly earnings month on month. That's expected to rise 0.3. If that comes out at like 0.5, for example, that will be bad for the markets because that will maybe tell investors the Fed might not cut. But if it's a low number, average hourly earnings like it unchanged, that will be good for the markets. So yeah, I don't believe, of course, in that 3.6% unemployment rate. There's almost 100 million Americans that are not in the workforce that could be. And the non-farm payroll number, of course, is a hypothetical survey, the 160,000 that's expected. So it's just past 8 o'clock here this morning. Gold is at 1450. It's unchanged. The range has been 1412 to 1424. Silver is down about 5 cents at 1522. Range has been 1520 to 1535. The Dow is up about 6 points at 26,970, or actually about 4 points from the close on Wednesday. My IG index is giving me down 32, but I think they settled it yesterday, the future. So yeah, we're going back to unchanged now from the day before July 4th. Same thing with the S&P and NASDAQ. Currencies still fairly steady. Cable unchanged, 125.77. Euro is down 0.1%, 112.72. Dollar is up 0.1 versus the Japanese yen, 107.90. The dollar is up also 0.1% versus the yuan at 688.20. Crude oil, WTI 56.70, down a quarter, and Brent is unchanged at 63.17. The 10-year yield is still, deeply in, inverted territory versus the 3-month. We're at 195 right now. We have been to 194 overnight, and the 3-month is at 221. So 26 basis points inverted still. Not a good sign. If you enjoyed this video, make sure you hit the like button, subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.